Hi, folks, and welcome to Money Ed Financial Academy. I'm your instructor for today, Jerry Penner. If you have credit cards and pay them off each month in full, congratulations! You don't need to watch this video. You saved yourself several minutes of me telling you what you already know. Mortgage rates are about the lowest interest rate you can get on a loan product, typically between 3% and 8%. HELOC rates are typically between 5% and 12%. An unsecured loan is typically 12% to 18%. Credit card debt typically ranges from 19 to 29%, with some as high as 35%. If you're not paying off your credit cards each month, you are paying for some of the most expensive debt you can get. Teaser rates are the worm on a hook to get you to use debt. The lure of cheap money is strong. But if you can't pay off the debt before the teaser rate expires, you may be paying 29% instead of the teaser rate of 9%. You got the teaser rate money because it was cheap. How are you going to pay it back now? I can't stress this enough. Read your credit card agreement. Read it again. Keep going until you understand it. If there's anything you don't understand, make an appointment with your banker and have them explain it to you until you do understand. Your credit agreement states the rules of engagement for both you and your lender. One of the things it tells you is what happens when teaser rates expire. Some banks structure the teaser rates such that any balance not paid off when the teaser rate expires has interest recalculated to the full rate from the time the debt was incurred. Another thing it'll tell you is the sequence in which your payment is applied. Any money you put down on a card is applied in this order. First, overdue payment fees, overdue payments, then current interest, then any purchases you have made. So how do you calculate the interest? It works like this. In either your credit card statement or your credit agreement, the annual interest rate will be listed. If not, call your bank and find out what it is. Let's say it's 29%. Let's further assume your credit card balance is $10,000. Divide the annual interest rate by 12. This gets you the monthly rate. This is not precise down to the penny because the bank will most likely calculate a daily rate and multiply it by the number of days in the month, but for our purposes, it's close enough. A 29% annual rate is 2.42% per month. To convert from a percentage to a multiplier, divide the percentage by 100. So 2.42 becomes 0.0242. If your card balance is $10,000, multiply 10,000 by 0.0242 and you get a monthly interest charge of $242. How long does it take to pay off? Here's the calculation. This example assumes you've stopped digging and aren't putting any more purchases on the card. If you're using a dollar store calculator that doesn't have brackets, throw it away. It will not give you the correct answer because it doesn't know the order of operations that you were taught in high school. Month 1. Take your balance and multiply it by 1 plus the monthly multiplier. In our example, that's 1.0242. This gives you the balance plus the monthly interest. Subtract your payment and you have the new beginning balance for month 2. Repeat until the balance is 0 or negative. If you're good with spreadsheets, you can save yourself a lot of time in manual calculation. You can also use the spreadsheet to run what-if scenarios. You can learn what happens if you increase your payment or get a lower interest rate. For paying off credit cards, there are 2 systems to choose from, the debt snowball and the debt avalanche. With the debt snowball, you choose the card with the smallest balance and pay that off, then the next largest, and so on. The debt avalanche has you select the card with the highest interest rate and pay that off first, then the next highest rate, and so on. While it seems you can keep more money in your pocket by using the debt avalanche, there's a bit of human psychology at work that causes the debt snowball to work better. The debt snowball produces a zero balance credit card way before the debt avalanche method. Your internal reward system runs on dopamine. You get a dopamine hit whenever something good happens, like paying off a nasty card. The debt snowball gets your first dopamine hit sooner. The faster reward prompts you to do it again with the next card. So to pay off the debt using the debt snowball, take the 15% you have set aside for debt repayment in your budget and apply it to the card with the lowest balance. Pay the minimums on every other card. Continue until the card is paid off. You are now in control of that card, not the bank. Call the number on the back of the card and let them know that you would like to cancel. You will be transferred to a customer retention agent. Customer retention has the ability to make deals to keep you as a customer. Tell the customer retention agent that if they can cut the interest rate in half for you, you'll transfer your balance from another card. If they say yes, congratulations! You've just negotiated your first credit card rate reduction. Don't actually use that new rate though. Set the card in a safe place. The object of the game is to get your debts paid. If they say no, cancel the card. Repeat the process with the next card, putting the amount you were paying on the first card against the second card, plus the minimum amount you are paying on the second card. This is the snowball effect. Keep going until all cards are paid off. Keep one card active. Revolving credit is so called because you can make withdrawals and payments in any amount at any time, unlike a mortgage. If you can keep your in-use revolving credit level below 30% of your maximum limit, your credit score goes up. Why? Because credit card companies have millions of customers and billions of data points showing trends. Customers who keep a high level of revolving credit in use tend to go bankrupt more often than customers who don't. If you've got room on your card and an unexpected bill comes up, you've got the funds to cover it. If you don't, you don't, and bad things happen. Your homework for today is to pick the credit card balance you're going to squash first and start paying it down. How much is it? How long do you think it'll take? Leave your answer in the comments.